This quarter was all about 1 week in August, and that 1 week was all about China and the Fed. Markets finally caught up with the fact that China was slowing more dramatically than the bogus official trajectories, and the straw that probably broke the camel's back was the collapse in the manipulated China A-share market that so many investors had been lured into. Sentiment turned dramatically when the same investors then fretting that the severity of the downturn would impact global growth, and in an increasingly illiquid financial environment, we had an adjustment in market prices. As a side note, it appears that regulators have missed the point that liquid markets are an important safety valve and have actually served to increase the risk of volatility, counter to their objectives. Then we had the Fed, who seemingly looks for every excuse not to increase rates. Their paranoia only serves to increase corporate conservatism and thus holds back the magnitude of economic recovery. They should have raised 12 months ago, and hopefully they will so soon. Now, points of interest to me was, first of all, groupthink and the increasingly process-driven investment world. It was not that long ago that China was supposed to grow forever, and thus resource stocks were the place to be. With such a high weighting in the local ASX index, BHP was a must-own in Australian-mandated investment portfolios. A double whammy of groupthink and process-driven index mentality. Despite the fact that commodity prices peaked in 2011, it is only recently that investors have truly started to doubt the resources story. With BHP down 65% from its peak and the survival of Glencore, the world's largest commodity trading corporation, being questioned, the myth of ever-increasing commodity demand has been well and truly busted. We still think it will be a long workout for the industry, and until managements truly throw in the towel by cancelling their dividends, we are likely to stay on the sidelines. Now, dividends brings us to our second point of interest and the busting of another Australian myth that dividends would support our banking stocks, and again, being such a big part of the index, a must-own. The big four banks in Australia declined 30% recently from peak to trough. Now that's the equivalent of approximately 8 to 9 years of dividends if you're on the top marginal tax rate. We still think offshore banks are a better proposition, and again, until management stop trying to manufacture sustainable dividend yields, and you might note Westpac's rights issue that was announced today, and move to a more sustainable payout ratio, this is unlikely to change. The resources and dividend myths that have been well and truly broken highlight the dangers of groupthink and index market exposures. It's illogical that you would want to own every business at any point in time. That's why we are stock pickers who simply look for opportunities to selectively invest our capital when we believe we'll be afforded an acceptable rate of return. This will be increasingly important going forward, and when it comes to myths, I suspect the next one to bust will be Australian property. I suspect we are where commodity stocks were in 2011, and it will probably take a generation to well and truly bust, but it will be very interesting to look back in 10 years' time and reflect on current valuations. With respect to today's environment, we still think it is better to own a business than a government bond which gives between 0 and 2%, or property. Market returns will no doubt be more subdued post such strong returns, and earnings growth and dividend yield will do more of the work. But short term, the market will probably take direction from third quarter earnings, but we still suspect that the developed economies will continue their low growth return to normality, and thus our belief that we'll earn an acceptable return from the businesses that we own. Now, on the currency front, the Australian dollar has declined significantly, and I suspect will settle down short term. We still believe that it is biased to the downside, but it is probably about right for current circumstances. Further downside may depend on rising US rates, but who knows if and when and the magnitude of that occurring. So in a nutshell, there is no change to our core thought processes. We continue to believe that our capital is best placed in a selective group of offshore businesses, and again note our often repeated mantra that returns do not come in a straight line. It's the end of the journey that counts. Thank you for your time.